We have so many negatives within a wildly positive framework that we can't process what's going on. Hence how the market could open so horrendously, then rally off its lows, only to pull back again.
Woo! Baby, there is a lot of angst in this stock market. A rally, the bulls, the bears, fighting it out if this is a bear market rally heading into some further lows in the future, or damn it, are we actually seeing a soft landing as the Federal Reserve is trying to predict to actually give some gains in the market? A little bit of hopium going on. Who the heck really knows? But this has led to one hell of a fixation on these dividend recession-proof kind of investments because, again, you can sit back, collect the cash flow, and know people are going to keep paying these bills. So we're going to fixate on what I consider the best Canadian dividend stocks, because not only are they increasing dividends over the last quarter, but they're also doing a crazy amount of acquisitions. And I don't know if that's because of the bear market, of them trying to fight to keep revenues up, or just taking advantage of suppressed prices and companies trying to say, I don't know. But let's start kicking it off with Royal Bank. We can't talk about Canada without talking about the banks. And Royal Bank here has been really cushioned against this recession. I mean, take a look at the recent highs coming into 2022. This thing's only down 6%. Year to date, it's up 8.29%, outpacing a lot of the market rallies here. More on pace with the S&P 500, paying a 3.82% dividend yield. This thing has been increasing the dividend. I mean, look at the growth here after that steady blockage that happened after the pandemic, because all the banks had to like freeze the dividend increases, but still no dividend cuts, right? But now it's like doubling up the pace of the dividend increase, which is really nice to see, right? And considering when we're looking at tech companies, it's kind of incredible to think the insane high margins. Look at the operating and profit margins of Royal Bank here. They're in the 30 to 40%. The payout ratio is only 44%. This thing is world renowned for a reason, and obviously one of the best, is the best Canadian dividend stock because it's also the largest company in Canada. We recently talked about this, but I want to bring it up again because it's going to really pair with the other stocks we're going to talk about, and that is these acquisition sprees currently going on with these giants. I mean, HSBC is a huge bank here in Canada, and they're buying this, the Canadian branches, 130 of them for $13.5 billion. So it'll be neat to see when all of this comes into play with their earnings. But TD is doing something very similar here. Now, TD Bank, giving a little bit more U.S. exposure. This thing's down about 14%. Not nearly as less volatile, I'm going to say, as Royal Bank to some extent. I mean, Royal Bank, I don't know how it's remained so steady Eddie, right? But taking a look, this thing's paying about a 4.16% dividend yield, comes in at a better valuation of a 9 PE. And again, same sort of deal, a little bit of blockage in the March 2020, but again, dividend increases as of the last quarter. And just taking a look, this one falls in line very similarly with the profitability. And again, the payout ratio is actually lower at 37.59%, yet a higher yield. These things, God, you got to own them. The Canadian banks are like Pokemon cards. As I always say, you got to catch them all, right? But taking a look, they are set to acquire an acquisition here that's been on hold because of regulatory approval. But First Horizon, which is apparently going to accelerate the U.S. growth strategy they have, considering it's creating a top 6 U.S. bank with an immediate presence and scale in the fast-growing TD adjacent markets. This is another really big $13.4 billion deal that's going to be going on. And again, it's all kind of happening roughly the same time between the last couple quarters of last year. These were announced. So it's just really intriguing to see what is with these crazy acquisitions. And my favorite telecom giant is doing something very similar. We got Telus here, which is it is probably the best, in my opinion, of the Canadian telecom giants, with a almost 5% yield. Trades at a bit of a hefty premium. And if you're looking for cash flow today and somehow still getting incredible growth over the long term, this thing has been pretty resilient recently, increasing the dividend, really nice stuff. Payout ratio is a lot higher, but telecom giants have big infrastructure costs that they usually write down against their income. So you might want to do a little bit more math when the earnings come out just to see what the actual payout is before the write downs of their infrastructure. And this one, not nearly as resilient on the profitability either, but that could come into the high, again, infrastructure cost. Those write downs are something that make a lot of REITs and big telecom and utility companies hard to wrap your head around. Caused some concern there with Algonquin Power and Utility Corp. Don't think people really understood the mismanaged debt, because I missed that one. But nonetheless here, these companies are absolutely incredible, and Telus is going to be doing also a $1.2 $2 billion purchase of Willow, kind of an app self-service tech provider. And it's neat to see that they're continuing to diversify, because Telus has a lot of diversification. They've got telehealth, they've got security, they've got, Wi-Fi, obviously cell phone plans and bills and internet, all that stuff, right? So this is another really intriguing trend that I've noticed going on between all the mega cap companies in Canada. And again, I don't know if it's just them trying to take advantage of the bear market, or if they're trying to prove out some, revenue growth and offer some stability during this volatile market in this slowdown period. I don't know. But hey, it's nice to see they have the liquidity to actually pull this off when venture capital is clawing to get liquidity and actually survive this market. So really intriguing stuff. But if you don't like the risk of these individual stocks, and something I don't talk about a lot is a couple of these ETFs that I think are really resilient. They're really great to hold for those of you looking for the Canadian exposure in a similar fashion to an S&P 500 ETF like VOO or, SPY. Now, VDY, the Vanguard FTSE Canadian Index, we're going to compare this to my dividend ETF VDY, the Vanguard Canadian High Dividend Yield ETF, because this thing is, again, a very comparable ETF, market cap weighted just like VOO or SPY, and it's been proving really resilient kind of over the last year. I mean, it did dip to about a 15% low, not as low as the S&P 500, currently down about 6% from all-time highs. But you can see over the last 5 years, you're getting about a 42% return from capital growth. And I think this is a much better place to park capital for those of you that don't care as much about dividends, but want exposure to those best performing stocks here in Canada at a very low expense, because this thing's management fee is at 0.05%, which is a lot lower than VDY, but so is the dividend yield at 3.3%. And taking a look at that dividend, just to give some insight here, I don't like this for dividend income as much as I do the growth side of it, because you'll notice it's a quarterly paying ETF, and we can see because of the market cap weighted stocks moving in and out, some of those have lower yields, some of them have higher yields, so there isn't as much stability or growth I've noticed in this ETF over the last 5 years with that dividend. But nonetheless, just taking a look at the way it weights companies, you'll notice that the sector allocation is still mostly financials and energy, because it's what makes up most of the Canadian economy, with 40% financials, and you can see about 18% in the energy market. And again, these are all the top weighted companies. Royal Bank, 8% of the ETF, 7% in Toronto Dominion, Enbridge at 5%, Canadian National Railway, the Warren Buffett favorites, right, at 4.5%, Canadian Pacific Railway, so on and so forth. But I want to give you a comparable performance to VDY, the Canadian dividend ETF, and pretty much my only current exposure to the Canadian markets outside of some small cap investments. But we can see that this one over 5 years is only up 35% over VCE's 42%. But again, this thing pays out a higher dividend by over 1%. So that's an extra 5% return. So I feel like you're getting a very similar return, just one's paying a little bit more out in the dividend instead of seeing the capital growth, right? But again, you're paying for that because the expense ratio is at 0.2 instead of the 0.05 with VCE, and you're getting that yield of currently 4.42%. But we should look at the performance over the last year. It dropped about 17 to 18%, so a little bit more volatility and comparable to VCE, but again, only down 7% from those 1 year highs. But just taking, again, let's break down the components, sector exposure. This one's giving you a little bit more risk to the sector allocation, and just to show you what I mean here is you're already getting the financial exposure in VCE, but this one bumps it up to 55% and energy at 27%. So damn near 80+% of this ETF is giving you exposure to these two sectors alone, with about 14% in Royal Bank, 12% in Toronto Dominion Bank, and Enbridge making up 8%. These are huge proponents. Like over 35% of this entire ETF is in 3 stocks. But when it comes to those dividend payments, this is why I love VDY. It's a monthly paying ETF, and there's a lot more stability and growth because this ETF fixates on the best Canadian dividend stocks. You can see here there was some volatility in the past as it adjusts some of the weightings. But lately we have been seeing much higher increases and much more tightening of the monthly spread, which is just really, really nice, making this one obviously my favorite Canadian ETF of all time. But again, I think if you're looking for income, this is where you want to go. But if you're not worried about income, maybe you're younger, you want some growth, and you don't want to deal with taxes and stuff like that, even though the Canadian economy is incredible for taxation. I mean, when it comes to Canadian companies that make 50% of their revenue in Canada, you get a huge tax break outside of tax advantaged accounts. But even in your TFSA or RSP, you're not really paying dividends dividends anyways, but these two ETFs I think could pair very well together, or you could just own one or the other, get some pretty good exposure. But at least with VCE, you're getting that exposure to the tech companies like Constellation Software or Shopify, for example, whereas you're not really getting that exposure in VDY. And I want to pass the question off to you. What are your favorite Canadian dividend stocks or ETFs? And do you think we're heading into a bear market and this is just a short-term hiccuped rally, or we're truly starting to see a soft landing? I'd love to hear about all of it.